Hi everyone, let's go over my bullish and bearish Elliott wave scenarios on Bitcoin, starting with the conservative bullish scenario on the weekly time frame, where we are looking for a 5-wave impulsive structure to the upside, and after wave 5 we are looking for a bear market to come. The most common target for your wave 4 is between the 236 and the 0.5 Fibonacci, taken from the start to the end of your wave 3, giving you a target between 57.1 and 42.8k, with the invalidation being 37.7k, and at the moment nicely respected. Now, based on the current low that we have on the chart here, we can estimate the target for a wave 5, currently sitting between 81.3k and 129k. In this case, we want to see a 5-wave impulsive structure to the upside, finishing in this area here, and then start a bigger range and a retracement to the downside. And once this range is starting, what we want to see on the daily and the 4-hour time frame is impulsive structures to the downside, meaning we want to then see a 5-wave impulsive move down so that we can get a retracement and a bigger move down once again, a potential diagonal 1, 2, 3, 4, 5 correction continuation, or a multi 1, 2, 1, 2, 1, 2, and a bigger move towards the downside. But by all means, we're looking for a bigger sideways range to form a rejection, retracement, and continuation. This is contrast to the more bullish scenario, where we are looking for a double 1, 2. So here we have a wave 1, 2, 1, 2, look for a big wave 3 to the upside, and then another 4, 5, 4, 5 to then end the bull market and then start a bigger bear market towards the downside. But this one has a lot more potential with much higher targets. But what we want to see in this particular scenario is only short ranges towards the upside. So we want to see a wave 1, a wave 2 locally, and then we want to see a big push to the upside in a wave 3. And inside that wave 3, we don't want to see very long sideways big ranges like this one over here. We want to easily move past the target area for your wave 5 to finish your wave 3, start 4, and then 5, right? We want to see price move up impulsively, volume moving to the upside as well, and we only want to see short ranges, move up, short range, move up, short range, move up, short range. We don't want to see these type of ranges very soon around 100k. That would increase the probabilities for a wave 5 to finish and a move to the downside instead of the most bullish scenario. Now, sometimes I get the question, how is this move to the upside comparing to the previous bull market? Now, what you can see here is that we had a move up, quite a long sideways structure, move up, and again a long sideways structure. The length in time of this current sideways move is about the same time as what we had over here. Now, what you prefer to see in an impulse is that you have a wave 1, 2, 1, 2, and then you get your big wave 3, right? Where you have your wave 1 and 2s, your double 1, 2 is overlapping here, 1, 2, 1, 2. There's overlap between the double 1, 2 here. And your second wave 2 is also a little bit shorter in time compared to your first wave 2. This is very nice. You can see that between these two 1, 2s, the double 1, 2, there's quite a big distance, right? So that is at least something we have to keep in mind. And the question is, are we even here? Or are we maybe in this particular range here? Because here you can see we moved to the upside, had a retracement, then moved up and had a sideways retracement. And there is no overlap between the two. We have a bit of a gap here, right, towards the upside. And then we got a big retracement to the downside. So by all means, we have a structure to the upside where in both of the higher probability scenarios, we are looking for price to still take out the all-time high, either in a wave 5 or in a wave 3. So what you have to know before you start dreaming about a 500k per Bitcoin is that if you do take out the all-time high, you do not want to see very big sideways ranges, the size of the ones that we have over here, already between 81k and 130k. You want to move to the upside and create very short sideways ranges, of course for many people known as bull flags, to continue the move towards the upside and have increasing volume to the upside as well, like what we have seen to the upside here, right? So we moved up, right? And then eventually the volume picks up as we break towards the upside, and that is exactly what you're going to be looking for if you want to reach 500k, but we are only at 60k, and in my opinion as a trader, it is much better to be conservative than being such a moon boy and think about the 500 or the 1 milli once upon a time, right? Now, if price moves towards the upside here and we get the ranges, of course here, we're going to analyze these ranges, and if the probabilities are higher for it to be a corrective range, we expect continuation, which is the same over here. Looking for price to move up, we are waiting for the ranges to form, ranges forming, probabilities based on the local analysis are higher for price to move towards the upside, take out the all-time high, and this is how we are going to do it step by step by step by step. We're going to look for price to move up, observe the range, look up, observe the range. If the range over here is a corrective structure, we look for continuation. If it is, however, a more impulsive structure, we can already start looking for price to move down to much deeper levels. If we move to the daily time frame, then the bullish scenario is a finished three-wave corrective structure, and we now want to see continuation of the trend to the upside and take out the all-time high. Now, nothing goes in a straight line. What we are looking for locally is then a five-wave structure, correction, and continuation. The most common target for your wave C has been hit. It is a trend-based fib extension taken from the start to the end of A to the end of your wave B, giving you a target between 52.6 and 48.5k, nicely respected, and now this low is your invalidation at 49k. The bearish scenario on the daily time frame here is a bigger three-wave corrective structure in a WXY, but it does have lower probabilities compared to the bullish scenario. Let me explain why. The reason is that the target area for your wave Y is most commonly the yellow box on the chart, a trend-based fib taken from the start to the end of W to the end of your wave X, which as you can see is hit. The 1.618 is only a rare target for a wave Y, right? It is very uncommon for your wave Y to move all the way down to the 1.618. And what we are looking for inside wave Y would be a zigzag in an A, B, and a wave C. However, if we want the target for wave C, which is the white line over here, to be at least relatively close to the 1.618, then price locally has to move up to at least 65, 66, 67k for the 1-to-1 of C to be at least relatively close to the 1.618, which by itself is already an uncommon target for your wave Y. So the probabilities aren't too great at the moment for this particular scenario to take out this low with another wave C. First of all, probabilities would be higher to then locally first move up, right, and then see another leg to the downside, but you're gonna hit that 1.618 very, very likely, because the most common target for C is between the 1 and the 1.236, which is even lower. Not hitting the 1-to-1 for wave C is very rare, never preferred unless all of the other stuff fails, right? So therefore, the probabilities are not really on the side for this scenario. And if this would be the end of your wave B here in an A, B, and a wave C towards the downside, then the target for your wave C, as you can see here, is going to be about a 41.6k. But look how far it is below the 1.618 for wave Y. Right, so there's no clear Elliott wave confluence between the higher degree target, which is the wave Y target, right? Most common target here, uncommon target here, and then the most common target for your wave C being the 1-to-1, at least not with this being the high for B. So even in a wave B, preferably, we are still looking for higher prices locally, moving towards 65, 66, 67k. More to come on the 1-hour time frame. If we then zoom into the more bullish scenario where C is finished and we look for an impulse to the upside, then on the 1-hour time frame, we are looking here for a double 1-2. Now, the reason we're looking now for a double 1-2 is because this second leg to the upside is the same size in price as the first one. If you take a trend-based fib from the low to the high of your wave 1 to the low of your wave 2. You can see here that the 1-to-1 is hit, and for wave 3 it's not really a common target, as most commonly wave 3 is extended. So therefore preferably we count this as a 1-2-1-2, continue to the upside. Now the most common target for a wave 2 is between the 0.5 and the 786 Fibonacci, taken from the low to the high of your wave 1, 58.6 to 56.3k. An uncommon target is the 382 at 59.6k, but it is a target nonetheless, and it is a target that we have hit. If we then look at the bearish scenario on the 1 hour time frame, which again is in line with the bigger ABC on the daily time frame, where we actually want wave B to move up to 65, 67, 68k, then the only way to really get there in a corrective manner would be a double zigzag structure, where we then have a finished ABC to the upside, a 535 labeled as a wave W. Your wave C hit the 1-to-1 trend base fib extension, taken from the low to the high of A to the low of B, which is a common target for C, so that is perfectly fine. But then we're still working on a wave X and want to see a wave Y towards the upside. And this is also where it starts to get very, very interesting, because for a wave X in a double zigzag, you do not want to hit the 0.7 at 53.1k. If you do, the probabilities will go significantly down for this particular scenario. But you actually do want to have a very deep retracement to the downside, because look what happens if you don't. The common target area for your wave Y in a double zigzag is between the 1 and the 1.236 trend base fib extension, taken from the start to the end of W to wherever X is going to end. But you can see that at the moment the low of X is positioned below the 0.7. And that is the only way to get the 1 and the 1.236 both below the invalidation of this scenario, because on a daily time frame, your wave B is not allowed to take the high of your wave X, right? But if I move the target for your wave X towards the upside, and we do have some additional support. So for example, let me put it on the box here, 54.8k-ish, right? And I remove the targets again to clean up the chart. Then you can see that the 1-to-1 target is already at 68.5k, which is very close to the invalidation of the whole scenario. And it is also right around, or actually even above, the 886 Fibonacci for your wave B on a daily time frame, right? So that is not really great, right? The 886 already increases probabilities to eventually take out that high. So yes, wave X has to be a very deep corrective structure, preferably not hit the 0.7. So we could go as far as, let's say, 53.9 or 54k, right? To at least have the 1-to-1 sit at around 67k, which would be good. But if we do not get a retracement to the downside this low to 54k, but instead range here for a bit and move towards the upside, the probabilities do increase on the 1 hour time frame for more bullish scenarios, which then is the 112 mentioned here on the chart. Finally, on the weekly time frame, the lower probability scenario is a bigger move to the downside in 3 waves, where the target for a minimum bear market would be a 30k, before then a move towards the upside. Again, doesn't have the highest probabilities. You would really need to lose at least 38.5k. And if we then look at the probabilities of the different scenarios, then on the weekly time frame, the probabilities are higher for the bullish scenarios, where we are going to take out this high, compared to the bearish scenario, where really you want to move below 38.5k. Of course, we have 2 bullish scenarios: the conservative bullish scenario 1, 2, 3, 4, 5, and the more bullish scenario, a 112 followed by a wave 3. But before we start talking about 500k and 1 million and I don't know 400k, it's much better to be conservative and just take it step by step, range by range, level by level. That's exactly what we're going to do here. If price moves to the upside and takes out the all-time high, then every new range that is going to be forming is a range we're going to be analyzing. And if the probabilities are higher for this to be a corrective structure, just like we had over here, just like we had here, just like we had here, we're going to look for price to move towards the upside. But if we do count impulsive structures up, be aware. On the daily time frame, the probabilities are also at the moment higher for the bullish scenario, where we have a low here and look for impulsive continuation at the moment. But in both cases, even in the bearish scenario, preferably you still move higher to at least 65, 68k, right? And on the 1 hour time frame, at the moment, the probabilities would be higher for the bullish scenario, the impulse, compared to the bearish scenario. I hope that this video was helpful or valuable to you. Please check out the brand new complete Elliott Waves Guide playlist I've made that shows you all you need to know about Elliott Waves. Thanks for watching and subscribing, and I'd like to see you at the next one. Bye bye.